I sit here, I say all I buy is a global index and I've got a little bit of play money. You say the same. Is that really enough?
What proportion of professional investors beat just a passive index? When I was part of the investment banking world, it's never even discussed.
Then the American market's about outperformed. Why not just buy the S&P 500?
If you look back over the last decade, the US just blows everyone out of the water. But what people forget, I don't really like gold because it's a wasting asset. And it's kind of like crypto in that sense.
How do you see bonds fitting into a person's portfolio?
Now, I'm really excited about that because, I think bonds are sexy. 6.5% above inflation for the last 120 years. That's what I'd have on my backside.
And on your ass. That'd be funny.
And then bonds would be on the other cheek. 2% less.
Today we're joined by Ramin, who owns the Pensioncraft channel on YouTube. Is how most people know you, but you're also the host of Many Happy Returns podcast as well. We just had a conversation then off camera where we were speaking about how picking individual stocks can be a bit of a mug's game, we say it. I subscribe to the mantras of someone like Charlie Munger or Warren Buffett, and they're also quite critical around diversification. Could you just explain why you think that a normal person should be diversifying or spreading risk?
I think it's really about modesty. You have to kind of admit what your limits are. And the thing to remember also is the stats. The stats for professional investors is, let's look at a 10-year global fund, right? What proportion of professional investors beat just a passive index? Turns out that it's something like 1 in 20. And these are professional investors that have huge resources. They're very dedicated. It's not like they're not trying. It's just that it's really hard job to do because markets are efficient. If there's any information that gives you an edge, chances are somebody else has already priced that into the stock or the bond or whatever it is. So you just have to be realistic and modest about what you can achieve, I think, and just honest. Just look at the stats.
Yeah, and like you say, it's about recognizing the skill that's involved from a perspective of these people are full-time professionals doing it in a company with unlimited resources. Do you think that you can beat them from, your 2-bed flat in Basingstoke? I think that's the kind of, I think everyone comes into it thinking, I'm capable, I can part-time become the best investor in the world, when actually, no, you probably can't.
I think that's it. You just got to be honest about what your chances are of success. And I think for most people, if you want to have a successful career investing, just ride equity markets up. It's so easy to do and so cheap now to do that, everyone can do that. That's within everyone's reach.
I think it's really interesting that you said it's important to be modest because we were doing viewer listeners' questions.
Not something that comes naturally to you.
I don't even know how to spell the word, to be honest. But we were listening to some listeners' questions. They said, someone said, why am I not rich yet? And I feel like a lot of people expect to make millions in the stock market or make millions in investing. How did you figure out that it's best to be modest? How long did it take you along your journey?
Interesting story that, because, when I was part of the investment banking world, it's never even discussed the possibility that, all these fund managers can't beat the index. It was just assumed. And so I always thought of this once I left it as a kind of cult. It's kind of like a cult of alpha. I don't know if you're aware of the two words. Alpha is beating the market. Beta is just tracking the market, which you can do very cheaply. So I think of it as the cult of alpha, because you don't know you're in a cult until you leave it and you become kind of deprogrammed, as it were. So I left and I kind of started Pensioncraft, and I came across this report about SPIVA, the S&P Index versus Active report. And that's where I first saw the stats. And I just couldn't believe it because all the people, you fly around the world as a strategist, you write research, you speak to the fund managers, they manage trillions, and they're super bright, super motivated. They're doing their best. And yet they fail something like 95% of the time for some of these categories of fund. And you just think, what kind of other industry in the world could you fail so often and still get paid?
Yeah. Why do you think that people continue to back that industry then?
I don't know. I think a lot of people don't realize what's at stake. I don't think they realize what they're paying their fees for. A lot of people don't realize they're paying fees or how big the fees are. So I think people don't realize the stats. I didn't realize, and I was in the banking industry for so long. So I think that's the problem. And more people are realizing now. I think in the US, for example, lots of people are shifting to passive. That's kind of ahead of where we are in Europe. But in Europe, it's still the case that you kind of trust people. And you just assume if you pay a professional, and the more you pay, it's kind of like the Lambo mentality where you think if I pay more for a car, it's going to be better. In finance, it's the other way around.
It's kind of like Emperor's New Clothes.
Exactly.
Yeah. Everyone's sat there going, well, he must be good. Yeah. So I think there's a knowledge gap, isn't there, as well? And I say it all the time, you get very smart people that stumble across your channel that are like barristers, lawyers, and they go, oh no, I finally get it. And it's like, this person is hyper intelligent, a doctor, but for some reason they feel that finance is beyond them. And then they're probably the kind of people that then go, I need to pay a fee. Because if you wanted my services, you would pay a fee. If you wanted a doctor, you get it through the NHS, but they're highly skilled. And they probably equate that to that side. But it's actually like saying, no, actually, if you just took a paracetamol, that'll fix all your ills instead.
Well, with medicine, at least, I think it's much harder. But with investment, it's actually pretty easy. And the simple fact is that equity trundles upwards over time. And once you understand that fact, everything else flows from that. So I think understanding those long-term returns, the base rates, which is just like the average return that you get for different investments above inflation, understanding and knowing that, it should be a post-it. I was thinking of, my daughter's just got a tattoo, and I was just thinking, if I had a tattoo, what would it be? And I think it would be those base rates, 6.5% above inflation for the last 120 years. That's what I'd have on my backside.
And what you're talking there is the on your ass. That'd be funny.
And then bonds would be on the other cheek. 2% less. Yeah.
A little bit of crypto on the nutsack.
Absolutely.
The high risk stuff.
You'd have the vol of crypto on my nuts.
This conversation's gone wild already. So, no, I can subscribe to this and say, but it almost feels counterintuitive, doesn't it? That you could do it cheaper and better than the professionals. Okay. And what we want to dig into is how does someone do that now? Because when they go on to a platform, it's still relatively intimidating. It feels like the funds are written in a language that's for professionals, not for individuals. You mentioned before you only have one investment in your portfolio. Can you just talk us through your investing process or strategy at the moment that you have?
Yeah, well, I would say before I talk about mine is don't copy what I do, because everyone's different, and but I will talk about my process. So when I started out, when I was working as an asset allocation strategist, I was paid to decide where to put the money, right? So we'd have a whole economics department. They'd come up with forecasts for growth. We'd have a fixed income strategist. We'd have a gold strategist. We'd have all these people feeding into our team because we were the kind of, the pinnacle of the research for the whole bank. So our job was to choose where to allocate stuff, right? So we think gold's going to be good this year, or we think European stocks are going to outperform based on all of these facts. But what I realized was, and it was actually a member of my community who said this, I had this really complex portfolio that was just a mirror of what I'd done in the past. And he said, that's a waste of time. Why don't you just put it into just a few funds? And so I made videos about it, and I realized, if I'm going to be allocating for a long period of time, then just buy global equity. That's all I need. And then the decision became, okay, how can I do that most cheaply? Here are the 5 funds which are the cheapest on the platform, which are global stocks. And I just bought the cheapest one. So, that's how I chose it.
Yeah. I know you've also done like recreations of like funds and stuff on other platforms as well. But you think just an off-the-shelf global fund suits your purpose, and does it recreate what you were doing in the past, were you saying? Were you overcomplicating it? Or?
I think so. And I'm not sure that I would have outperformed what I've got. I've got a fund portfolio where I do try and beat the market. And I had some great trades, like I bought commodities just in February of 2020, and that went up 80%. But I've had catastrophes. I bought K-Web, which is this like Chinese internet stock fund, and that's down about 70. So, I think you can try this stuff. You can come up with a thesis for what's going to outperform, but you're usually wrong.
Yeah. Yeah. You're late to the party. Like you say, if there's a lot of smart people that are thinking 10 steps ahead of you, and, Tritax is an example. I thought, they'll probably do well because of the lockdown. They did do well. And then I didn't see them doing badly. That's the problem, and then they fell off a cliff. So yeah.
But also all the cognitive biases, all of the stuff like you think, I'm going to stick with it because I think it'll turn around, and you become emotionally.
I was going to say, you shouldn't invest emotionally, right? At any time. Like you should always keep emotions out of your portfolio.
It's impossible though,
but
right?
I think it's impossible. I think for January 2020, I bought loads of airlines. I bought Tesla. I bought all these things. And I was like, they're all going to be back up. And a lot of them, like the airlines came back up, but a lot of them, like, up, back down. Like Tesla isn't doing too well for me. So I think, but Tesla, I was like, oh, it's Tesla. And I think there was one Neo, like, which is like a Chinese version of Tesla. And I thought, oh, electric cars, it's the future. And it just didn't perform how I wanted. But
this is why a global index is so powerful, because it's like, if you just buy it every month consistently, you remove any other rules, any other decision making. I get people all the time going, should I buy, should I sell? Well, I don't have to worry about this because I'm just buying it for the next 20, 30 years and then I'll consider selling.
I think you probably come after the Teletubbies, don't you?
Oh no, I remember the Teletubbies.
Oh, we were watching Teletubbies.
Do you remember the Tubby Custard machine?
Yeah,
where it had
Tubby
just
Custard,
the one machine, one button on the
One
machine.
button you push it and it brings out the
That's
custard.
it. So it's just like that. It's like the Tubby Custard machine. You just press one button and you get the returns.
Yeah.
So there's not much that can go wrong. And all of the kind of cognitive biases that come with stocks just don't apply. So for example, you were talking about Tesla. The trouble is that we always form narratives around the world and they're so compelling. The same as active funds. You know, if you have Terry Smith talking about how his funds run, that kind of thing. He runs a really popular active fund in the UK. Well, people buy into that.
Kathy
because
Wood was similar.
Kathy
Innovation
Wood.
became like a buzzword.
Disruption, and there's a story that goes behind it and a narrative which is really compelling. Whereas if you just say, here's a global fund which goes up, that's not quite as compelling. Even if it's tattooed on your backside, you know, you're not going to believe it, and it's not so exciting. So I think that's the difference. You know, there's no narrative, and there's less that can go wrong. So
can we talk then about? So I want you to make me feel better, basically. So there's the global index play. You bet on the whole world, it keeps turning. But then the American markets have outperformed. They're 65% of the global market anyway, and you can buy them for probably a quarter of the price that you could buy a global index. Why not just buy the S&P 500?
you can do, but the thing is, if you go back in time and look at the proportion of time the US has outperformed since 1970, and MSCI publishes indices for this, so you can figure it out.
They're one of the companies that track it.
That's the one.
MSCI,
I was looking at them for my fund.
Like S&P, MSCI, yeah.
But they show that it outperforms about 55% of the years since then. So there are many years. Yeah, just over half. So if you look back over the last decade, the US just blows everyone out of the water. But what people forget is the 1970s when we had a lost decade, or the 2000s when we had a lost decade, and the rest of the world outperformed. So I think it's always good to have that longer term perspective, because it's easy to anchor based on recent history. But you've really got to have that long-term perspective. And if you do, you realize that when the US is expensive, like it was in 2000, then that's usually a recipe for underperformance. You can't time it based on that. But if a lot of the pension crafters, people in our community, they're actually thinking about dialing down their US allocation because of this. So they, instead of having just a global equity fund, they've kind of got, you know, like regional allocation.
Well, they're getting a bit stuck.
Exactly.
It's a bit,
it is. And it's kind of timing as well.
Yeah.
But I didn't do it. And because every time I try to be clever, it goes wrong. So I've got to the point in life where I just thought, no, I'll just keep it simple.
Yeah. And that's all I do. And, you know, you might not get 9%, or you might get 7%. And I'm not really that bothered as long as it beats inflation.
Well, the thing is, you're so young. So for you, if there's a volatile period, or if the market crashes, or if there's a catastrophe, for you, it's amazing, because you're going to be drip feeding through that period, and it'll just boost your returns long term. So both of you have got the superpower when it comes to investing, which is time. Yeah. And there's not a lot that could go wrong as long as you just keep allocating. Don't sell when markets fall. Don't get overexcited when there's a rally, and dial up your risk. You just don't need to.
It made me feel better. I don't know about you.
Well, you're older than me, mate, so you got less of a superpower.
Only 1 year. Stop
It's going to be a big year, though.
There's no grey hair in either.
No grey hair.
But you didn't think we were old enough to watch the Teletubbies. I mean, I was too old to watch the Teletubbies. We're pushing. I'm the wrong side of 35 now.
Oh,
so,
no.
Are we? Am I? I'm 34. I can't even remember.
Damo, do you know what my favourite part of season 1 was?
I'm going to go with when Kerry Katona gave you a hug.
Good times. No, it was actually reading your bank statement. Hit it. What in the world is manual?
Oh, don't do me like that.
What is manual?
It's hair loss treatment.
Hair loss treatment.
Oh, I wish I'd asked for that clip to be deleted. But yeah, I've been using Manual for a few months now. I've been impressed with the service and the results. So I did ask them if they wanted to sponsor the podcast.
I mean, to be fair, your hair does look a lot thicker. I mean, not as thick as mine. Mine's pretty glorious and luxurious, but...
Luxurious?
But for the 50% of men who do struggle with hair loss, how are we going to help them out?
Maybe they should get one of those hair sponges that you use, or they could get 55% off their first order with Manual by using code MM55. There's a link in the description.
Now, back to the show.
And my original seat.
What I want to look at now then is, I think you come into it, you want to invest, and then I sit here, I say all I buy is a global index and I got a little bit of play money. You say the same. Is that really enough? Like, how many funds should people have in their portfolios?
I don't think there is a hard and fast number. I think it's good to understand all the moving parts of your portfolio. So remember that when you complicate things, it just makes it more breakable. And what breaks it is your behavior. So just having something you can understand is very important. And my rule was that I had to memorize all of the funds that I owned and be able to recite them from memory. And so that limited me to about 5 funds. So for me, that was limitation. Other people I know, they can do like 20, 30 funds, but I just wanted to keep it as simple as possible. But now that you can buy global funds, you can literally buy all the bonds in the world, all the stocks in the world, pretty much, with just 2 funds. Mm-hmm. So you don't need that many to be diversified. Or you can buy a diversified commodity fund, which gives you exposure to lots of commodities. So I think it's easy now to have these globally diversified portfolios very cheaply, and you don't need more than about 5 different funds in your portfolio. If you want to have more, that's absolutely fine. But just remember that you've got to manage it and rebalance it, and that's not easy. And the more moving parts you've got, the more complex it gets.
Do you keep the big fund you have? Do you have it in one platform or do you have it in different platforms?
Just one platform.
Just one platform.
And this is another question I often get, which is if I put it all on one platform, and some of the people I speak to have very large investments, like very large. And so they're worried that the platform will go down.
Yeah.
But fortunately in the UK, we're so heavily regulated. The platforms have to keep their money, firm money, separate from client money.
CAS rules.
Yeah, exactly. And so that way you can be fairly sure that if it does go down, it's unlikely that they'll have to sell your assets in order to pay off their creditors. I think there were some precedents for that in the UK. There was Beaufort Securities where it went down, but in the end, they didn't have to use client funds. But I don't worry about that. So I just keep it on one platform and it's simple.
One thing, we had the financial services compensation scheme come here, and they were very reassuring, in that sense of like the security and the bigger picture. One thing I'd like to ask then is, so we actually got a question from a member of the audience, Daniel, he's 21. Well done, Daniel, first of all, for being on this. He basically says, I've got an ISA and a SIP. I've got a global fund in both. Does that make sense to have the same fund in both vehicles?
The thing to remember is, why are you saving? So what's the horizon for the money you'll be investing? Now, sometimes people put money into their ISA because you can take it out anytime you want. They put money into there, which they'll need, like for, I don't know, could be a wedding, could be money for a holiday. But if it's short term, you don't want to put money into equity. So 5 years or less, equity is quite crashy. So you probably want to keep it in something much lower risk, money market fund, short duration government bonds, that kind of thing. So it really depends why you're investing and when you need the money. For a SIP, obviously he can't touch it till he's 55. So you definitely want a lot of equity in there, probably, because he'll want that high return. But I'd ask the next question would be, what are you investing it for, Daniel?
Mm-hmm. So let's say he came round and said, both are for 20-year time horizons. I would like to retire early using an ISA and have a SIP kick in retirement. Would you feel comfortable having the same investment in both platforms? I think is what he's alluding to, because he's basically like, I've just got a global all cap in both. Is that right? Should I be putting all my chips on the same?
I think so. I think because it gives you the same exposure. Because often what people do is they buy 2 different funds, like 2 different life strategy funds, or a target retirement fund and a life strategy fund from Vanguard. But they're almost identical if you plot the returns. And this is the point. You've got to understand the correlation between the things you invest in. Do they move up and down together in price? Do they have the same contents? Because if they do, there's no point in buying more of the same thing. But in his case, if it's for the same purpose, you invest in the same thing. So that's the important thing. You work back from your goals, and you work back from goal to asset allocation. Yeah. So that's the way it works.
A common one I see is people will say, I've got a global index, but I've also bought the S&P 500, and then I've bought the S&P 500 green, like electric cars. I'm like, you're placing a lot of chips on the American market by doing that, and I don't think people realize the allocation, as you say. How would people go about working that out? Do you know any simple ways to do it?
I mean, one way to do it is to go back in time to a market crash and just look at the returns. Did they crash together? And if the answer is yes, you're not
Just
diversified.
look at the chart and look at March 2020 and see what happened.
Yeah, and if they both went down at the same time, then clearly not diversified. Whereas if it's something that kind of held its value and didn't crash as the stocks fell, well, clearly that would be a good hedge.
But are you looking to hedge returns for me, I don't care if it drops because of my age and investing time horizon. I don't need something that moves the other way and dampens the drop and ultimately my returns. So do you think that some people should be looking to construct a portfolio that moves in opposite ways at certain times?
I think it depends on your temperament as well. Because some people, if you have a crash and you see that you've lost 50% of your life savings over the last 3 months, some people would really be badly upset by that. Other people say, look, I knew this was the risk. I'm happy with it. And I'm still feeding it.
That happened to me last year and I bought more.
Yeah,
when crypto crashed
exactly
like
right.
80%. And I'm like, discount,
It's the
let's
one
go.
good thing crypto
And everyone's
did.
looking at me like, you idiot, you're going to lose more money. I'm like, we'll see next year. We'll see, hopefully. But yeah, like I see a dip. I always buy the dip.
It's the one good thing crypto did was it made people harden to downturns. Like, what's 10% in the markets when
that's good.
You see 10% a day in crypto, but
There's a lot you can learn about investing from crypto. Like, you can see the entire trading book, you can see how bid offer works, all of that stuff you can learn from crypto. So it's good from that point of view. But I think the important point is that if you're going to be doing the asset allocation, what are you investing for? If you're young, then diversification doesn't matter as much, like you say, because you can weather the volatility.
I fully subscribe to your narrative of the global index, all of that stuff. What I want to talk about now is other things that people might want to bolt into that. So how do you see bonds fitting into a person's portfolio?
Now, I'm really excited about that because, I think bonds are sexy and they weren't until recently. The interest rates were zero. Who the hell wants a bond? But now we're talking about 5% return for almost no risk, lending money to the UK
Better than
government.
putting it in a savings account.
Yeah. And higher returns, or a money market fund, which buys these short-term government bonds and some other fixed income instruments.
Just for the people who don't know, can you just give us a one-liner on what a bond is?
So you pay 100 today, you receive a fixed amount, a coupon, for a fixed period of time, and then you get your money back. That's the way it works.
It's like an IOU.
Like an IOU, and it's got a maturity date, so you get your money back.
When you say
after that
maturity,
time.
you mean that's the day it ends and you get all your money back.
And then it essentially dies, and you just get your money back.
And the coupons are like interest payments along the way.
And they're fixed forever. So once the bond is issued, those coupons never vary.
So what's an example of a money market fund?
Well, there's one from Vanguard, for example. There's one from BlackRock.
And they're just called money market funds?
It's called a money market fund. And sometimes it's called a short-term sterling fund. Sometimes they call it that.
Maybe, or something.
They could call it a short-term or ultra-short.
How does it work?
Well, all they do is they just buy the really short-term government bonds. So let's say you've got a government bond that was issued 20 years ago, and it's only got 3 months to run. So it's like the last drags from a cigarette. But that thing, the yield on it currently is around 5%. So you're almost taking no risk, lending money to the government by buying this bond. Yeah. It's going to generate 5% return. And then when it matures, the fund will just go out and buy another one. So that way they kind of have a treadmill where they always give you this exposure. And if interest rates are going up, they pick up the higher rates almost immediately. So when the Bank of England hikes, Andrew Bailey, thank you, it's going to give you a higher income. So it's not going to help people who've got a mortgage, of course, but it's going to help savers.
Cash savings. And it's giving you a better rate than you're getting from a bank account. Savings banks, because they lag. They make like 3.5%, 4% maybe.
And if it's a call deposit, if it's just a regular deposit account, they'll give you almost nothing. Because from their point of view, that's runnable money. That's what will ultimately potentially kill their bank. So, they'll give you an incentive to lock your money in for 2 years, 3 years, and give you a high rate for that. But for the call deposits, which is just a regular deposit, they'll give you nothing. And people get upset about this. And there's a whole Treasury Select Committee meeting that happened recently where they were slagging off the banks for this. But I think you just don't understand why the banks have these and the kind of incentives from the bank's point of view. But yeah, so money market funds, very low risk, now a high return. bonds, if you're about to retire, you probably want to de-risk your portfolio.
So this is just watering down your equity, the stock position, to reduce the likelihood of falling off a cliff just before you retire.
And also, if you do these back tests, there are some brilliant websites like portfoliocharts.com where you can go and you can say, look, if I'd have had this portfolio, what returns would I have had over the last 50 years? Or for any 30-year period, what would have been the worst return? And what's surprising about this is even portfolios which seem to have complete lame ducks in them do really well. So, for example, the permanent portfolio has got gold, it's got long duration government bonds, it's got short duration government bonds, which is kind of like cash, money market funds, and it's got stock. And stock is a fairly small proportion of it, but that actually does pretty well long term because you do get these periods when stocks underperform. And by not crashing completely during those periods, it does pretty well. Not as well as single stocks, but still, it does perform quite well.
Would you go on?
No, I was going to say, do you invest in gold?
I don't.
Yeah.
I haven't in the past. I don't really like gold because it's a wasting asset. It doesn't give you any kind of income.
Doesn't multiply.
We had that discussion earlier, so I want to see your perspective on it.
And it's kind of like crypto in that sense because it doesn't do anything useful. It doesn't produce anything which is useful for anyone. It does have some industrial uses, but it's not income generating. You have to pay money to store it. So it does have a place. If you look at 2020, it did hold up fairly well. And in the recent crash in 2022, it held its value. So, it passes the crash test. When people are scared, they buy gold.
But you think something like bonds or money markets would be a bit better?
Well,
It's a return.
Yeah. Because, if you're going to earn 5% with a government bond for almost no risk, you compare that with gold, which is very volatile itself. It introduces crashes into your portfolio.
Yeah.
And now that interest rates are higher, that's a really toxic environment for gold because of this logic. It doesn't generate an income. It's volatile. Why would I buy that rather than government bonds, which very low volatility and guaranteed return almost?
There's also the question mark if Bitcoin's eating its lunch a little bit with the younger generations and whether there's going to be outflows from gold into crypto. There's a lot of question marks there, isn't there?
For the community, we've got this kind of simple model which prices gold based on the two things. One of them is interest rates, real interest rates. The other one is the strength of the dollar because commodities are priced in dollars. And for a long time, the value of gold was way below where it should have been based on the fundamental model. And a lot of people thought that was the reason. It was because people thought crypto was the new gold. Now less people think that.
Yeah, they do call it digital gold.
Yeah.
Similar, like you say, very similar store of value.
Hedge against
not limited supply.
But I think a lot of the narrative around crypto. I think what's incredible about crypto is the narrative changes as people perceive it differently. So it was seen as an inflation hedge. Nope, it's not. Because it crashed when inflation was high. It's seen as a good store of value. Nope, it's not. So it's hard to see what it is.
They're trying to find a use case.
Yeah. Exactly. You
now
find
it's an AI thing.
Yeah, that's right.
They attach it to the next bubble.
And the new bubble is, of course, AI. And
it was NFTs and Web3. It's surprising to me. We're going to get back onto portfolio allocation, but want to hear your point on this. And it's surprising to me just how quick people are to jump to the next bubble. So we're fresh out of NFTs. And to me, AI seems very bubbly. It seems very
everyone's chat GPT.
Yeah, I use a bit of chat GPT in my workflow and it's great. But, people are drinking the Kool-Aid, aren't they, with AI now? What do you think about it?
I think like all these things, if you overpay for something, that's the mistake people make. So if you buy NVIDIA now, well, that's the problem, right? You've overpaid for it. It's a great idea and it has to generate huge returns now in terms of the profits which it generates just to keep up with the price. Because what people forget is that the price of a stock has to keep in line with its profits. Sometimes it kind of gets ahead of itself like NVIDIA, but then ultimately it snaps back to some multiple. And if the earnings don't carry on increasing at an incredible rate now, unless they turn this into something hugely profitable, there's going to be a big correction at some point. So I think that's the problem with these shiny bubble syndromes. And I heard a nice description of this by John Authers, who used to be in the FT. Now he works for Bloomberg. He called it an echo bubble. People just remember all the previous kind of shiny balls.
And they don't want to miss out on the new one.
They think this is the next thing. So I think that's the danger. People overpay. But, after a crash, I think that could be an interesting point to invest.
Yeah.
If there is a market crash, then find the themes you like and buy them. But at the moment, my partner Laura, she just bought Nvidia. So,
Oh, really?
it was almost like a confession. She said,
I did it.
Yeah.
We have to talk. I've done something.
You're like, well, I've got a tattoo on my ass I need to talk about. So
And crypto on that.
yeah, while we're at it.
Yeah. No, but it was interesting because she thought, well, it's just fun. It's volatile. It's exciting, and there's kind of narrative that goes with it. So I think that's why she wanted to buy it.
Is she a good investor or a bad investor? Or?
Well, she always says she buys things that she feels in her waters. So,
This is so good.
so we thought we'd call it the hedge fund. We'd call it Laura's waters.
Yeah,
That'd be a good thing. Good chance as any,
Yeah, we'll probably beat most of.
That's right. Fundamental analysis. Forget it.
Yeah,
Laura's
feel
waters.
it in the waters.
Damo, you know what your problem is?
Hair loss.
Damn straight. Also, I noticed from time to time you get a little bit stressed.
Yeah, I think it comes with my job in a way. So when I post a video, I get quite anxious around that, throwing it out there and thousands of people watching it.
Yeah, I can imagine. Now, don't worry, mate. I got your back. I've got a little something for you. It's called Sensate.
Where did you get that from? You just whipped that out of nowhere, didn't you?
Don't worry, mate. It'll help you relax.
Okay.
And thanks to the good people at Sensate, we have a season 2 of Making Money podcast. Otherwise, I'd be on the street selling crypto. It's a pebble-like device and an app which helps you when you're feeling a bit stressed or anxious.
So, T, what's it going to do?
I'm not a scientist.
What?
It's to do with the vagus nerve and essentially managing your stress response. Our producer Will uses it every time you call him, stressing him out, and he says it's great. It works well.
Sees me dialing and reaches for the Sensate.
Exactly. And now it's your turn. Test it out. Let us know how it goes. Get your meditation on and report back.
All right, mate. Well, yeah, I'll give it a blast and I'll let you know.
If you struggle with anxiety and want to try Sensate, head to getsensate.com/makingmoney and use the code MM10 to get 10% off.
With the bonds thing, you're saying that they're now sexy. How do people know when they're not sexy again? Is it solely just interest rates are going up, so the returns on bonds are going up? If interest rate starts coming down, the return on bonds will go down.
It's not that simple because there's an extra dimension with bonds, which is the time that you lock in the rates, which are fixed. Okay, so if interest rates are increasing, you want short duration. These instruments pick up the higher interest rates really quickly, and they don't lose value as much if yields increase. Whereas long duration bonds get completely slaughtered. So in 2022, those long duration gilt funds lost more than they've ever lost, ever. Even if you can do back tests that go back 100 years and simulate them, there's never been a worse fall. So that's long duration is not what you want if rates are increasing. You don't want to lock in the rate for a long period of time. But when rates are falling, so let's just think forwards now to something like, 1 year, 2 years from now, inflation's going to be falling. Rates will also be falling because it's likely the Bank of England is going to be cutting the short-term interest rates. And if that's the case, you want to lock in those high rates for longer. So suddenly having long duration makes sense. So
it's similar to a mortgage in a way, how people might think about the interest rates on their mortgage.
Yeah, because
it might be
it's
a comparable, like, should I fix it? Is it variable?
Except you're taking the other side of the trade this time around. So if you're receiving income, what you want to do is to lock that in for as long as possible if you think rates are falling. So that's what people will probably do. Certainly the pension crafters are going to do.
So you would go longer, on the current rates to lock them in because you think they're probably approaching the peak.
So instead of a money market fund, which almost immediately pick up the lower interest rates, you'd buy a 10-year bond, a 20-year bond, because once you buy one, the coupon's fixed forever for the life of the bond. So that's why they become more attractive. So that's what you'd buy. And, so it really depends on what you think is going to happen to interest rates and how your thoughts are different from what the market thinks.
If people don't want to have that decision though, because like a lot of people, we're telling people buy a global index, so you don't have to think about it. And then when you talk about bonds, you predicting interest rates basically.
You do have to think about it. Yeah. So you do have to have some kind of view. But for other people, like let's say that you want to retire, okay, and then you want to buy a car every 5 years and you want to go on a holiday at this point in time and your daughter's going to get married in a year's time. Okay, so all of these events have cash flows that go with them. Wouldn't it be great if you had something where the money would pay out just in time? You'd know to the penny, to the day, how much you're going to get paid. Oh, that's a government bond.
Yeah.
So let's say that it's got a 5% yield. you only have to put 95 pence in for every pound that you receive. So my daughter's wedding's going to cost, I don't know, how much do they cost now? 30 grand? I don't know. You'd only have to put in 95 pence on the pound if the yield is 5%.
Yeah.
As long as you know when it's going to occur, you can plan almost
And
perfectly.
you can get that guaranteed return.
Yeah.
Yeah.
So I think for those planning purposes, it's really useful. And everyone has those. You know, if you're young, you still have to plan for this stuff.
Yeah.
You want to buy a fancy car, you want to buy a house, all of this stuff you can plan for. So I think that certainty is invaluable.
Yeah.
Because with stocks, you don't know what's going to happen. You know, it's so uncertain. You don't know what cash flows you're going to get. You don't know what it's going to be worth. It could crash just as you need it. And that uncertainty is a real problem.
And a certain 5-6% return is quite a nice return, isn't it? Especially if you're saying I need that in 2 years and that's money to get married with or whatever. So, you know, that fitting it in that, frame it in that sense from a portfolio allocation of see the bonds as a sure return and maybe set it towards a shorter term goal that I need in the future. Maybe you don't need to be predicting interest rates. You just go in, I want 5% on my 10K in 2 years.
And there's no prediction involved.
Yeah.
So when I did buy a single gilt about, I think it was in March, and I bought an inflation-linked bond as well, just to show the investors in our community how to do it. And I learned a lot from it. The link has been a wild ride, but the government bond, you know, I know exactly how much I'm going to be paid. And that certainty has been so valuable.
I saw the
for me.
process of you going through it. It was like you had to send smoke signals basically, didn't you? It was
That's
very
of course.
antiquated. Like you got a piece of paper and stuff.
And this poor lady at the other end of the phone, she had to read out all of the stuff
code
about
that
the
you
trade.
were given her. Do you remember? I was like, I couldn't follow it. Like I watched that video. It was really, it like, just shows how archaic that kind of process is.
But I was just listening out for a certain phrase, which she was going to say, which was dirty price. I knew what the dirty price should have been.
Dirty price.
That sounds interesting.
Oh, I
It's a
thought
dirty
you liked
price.
it.
Dirty price.
Tell me more about this dirty price. What do you get for this dirty price?
But once I heard the dirty price and I knew it was right, I knew that was fine. The dirty price is just what you pay. So there's a clean price, which doesn't have the accrued coupon in it, and there's a dirty price, which does. But for bonds, I think there's a whole language that goes with it. And there's this extra dimension, which is a time it's going to lock in the rate for.
Where do you buy your bonds?
There are certain platforms in the UK where you can, if you buy single bonds. If it's a bond fund, you can buy that pretty much on any platform. There'll be ETFs that give you the exposure.
What do you think's better? Bond fund? Obviously not better, but like what's the difference? Bond fund or like individual bonds?
The big difference is the loss. So let's say you buy a government bond and you pay a certain amount for it. You know what it's going to yield if you hold it to maturity. With a bond, you never sell it. You don't have to sell it. Yeah. You can sell it. You don't have to. You just wait till it matures and you get the money back. Yeah. That's the beauty. You never face the market again. And that's very different from an equity, which is a perpetual instrument. It never matures. So for the bond, you know what you're going to get and you have complete control over whether you sell it or not. Compare that with the bond fund, where the manager has a portfolio of bonds. If money comes into the fund, he has to buy more. If money flows out of the fund, he has to sell them. So you don't have the control over that. So let's say we go back to 2022 when there was the biggest fall ever in bond funds. And if you had a long duration bond fund, you'd have just had to take the hit. You know, you don't have to sell it, but you'd have had a mark-to-market loss. For someone who's got a single bond, you don't care.
Yeah. You don't even look at it. You don't even look at it.
I knew what yield I was locking in. Maybe it was 2% and it was lousy, but am I going to have a loss? No, I just hold it to maturity, make the 2%, reinvest it at a higher rate. So that's the big difference. It's the control.
Could we talk about REITs now as the next component that we could add in? Because I think, you know, people go through their investing journey. They get the stocks. They may or may not consider bonds. The next thing is they hear that they can hold property within an ISA. Do you think people should have exposure to REITs?
What in the world are REITs and how do you spell it?
REIT, Real Estate Investment Trust. It's a way to buy property or commercial property. I mean, you can buy residential as well, but you're basically buying a company that buys lots of property. So it's property exposure.
So you've got like a percentage of the property.
Ramin, I'll let you explain.
Well, the way it works, right? I mean, there's kind of tax benefits for REITs, but the deal is, let's say the three of us were going to start a REIT. We'd get commercial funding. You know, people would give us their money. We'd have maybe, I don't know, 100 million to invest. We'd go out, we'd find a property or a group of properties, we'd buy them. The deal is we'd have to pass on 90% of the rental income to our investors. And in return for that, we don't pay corporation tax. So for that income. And there's also a kind of tax benefit for our investors. So it's a really very tax efficient way to siphon rental yield out of property and infrastructure to investors. So that's what a REIT is. But the problems with REITs really are to do with liquidity. Because if you imagine that we've bought, 3 shopping centres, one problem is how much are they worth? What is a shopping centre worth? You don't know because it doesn't sell. So it's very illiquid. And then let's say that everybody starts pulling money out of our fund. Okay, we're going to have to pay them back. How are we going to do it?
Sell a shopping centre.
We have to sell one shopping centre. And if we've only got 3, then we're stuffed. So that's the problem. It's a very liquid instrument with very illiquid assets. And so that a lot of them get gated when there's a crisis, which means they turn around to their investors and they say, nope, you can't take your money.
They hold all the withdrawals.
They go Neil Woodford on you.
Yeah, Neil Woodford.
Well, it happened recently with BlackRock, for example, which had one of these REITs, which was a huge one. And there was a crisis and people, it was gated. So that makes a lot of people angry. In a down market, especially, you can see the value dropping and you can't sell it. So just be aware of the liquidity problem. Don't think that it's like fixed income because it pays you a high income, because it's not. The volatility is usually like equity, i.e. it's quite crashy. If you don't believe me, just look at Land, which is a UK REIT, and that just crashed hugely in 2008. So it's very volatile. Usually it's got specific exposure to one country. So
or one type of property. It could be office space, for example, which at the moment, clearly not very popular. Yeah.
Just like
out of town retail again.
Just like any other investment,
Exactly.
there's no entry levels. You
can put £1 in them.
You can put
very,
just
very,
like an
very
ETF.
easy to get into.
As long as you can afford the share price. And now they've got fractional shares.
If you rent and you want exposure to property but you can't afford a deposit, you can get exposure to property and the fluctuations and the ability from rent through a REIT. How do you think people should be thinking about, I own a home that is part of my portfolio. By buying a REIT, I'm overexposed into property. Do you think that people should think about that?
Well, domestic property behaves very differently to commercial.
Yeah.
Commercial is very cyclical. Yeah. So let's say you've got exposure to shopping centers in America. If America goes through a recession, you're stuffed. You're going to lose value on the rentals and, the price will go down a lot. So I think it's important to know that you can diversify REITs. You can get regional ones. You can get global ones. You can get sectoral ones where you just buy one sector. So just understand what's in it and what you're buying. And that's not as easy as it sounds. You have to really read in through the documentation for the fund to know what you're buying.
Do you have any REITs?
I have one actually, which is Big Box, which is the one that buys these massive
Amazon, the grey boxes on the motorways.
Oh yeah, the big ones.
That's right. It's been a catastrophe in terms of investing, but it's giving a pretty high yield.
I got a bit of realty income as well, which I think is like the OG, isn't it? The big boy. That makes sense. The REIT game, it's like the big one. But yeah, I mean, I'm like you. I have different portfolios where I experiment, and I don't talk about them too much because my job is to talk about this. So it helps for me to have irons in the fire, if that makes sense. So I'll have a dividend portfolio. I'll have some speculative growth just so I can keep a look on the market. And within my dividend portfolio, I think I've got realty income and a few others, and it's doing terribly. It's all doing terrible.
But usually your house, I mean, if you have buy-to-let, a lot of the people I speak to, they have buy-to-let. It behaves kind of like an inflation-linked bond because it provides you an income. It's fairly safe. You do get some capital growth. Usually it keeps track with inflation, but not a lot more. But that's what it gives you. It's like a bond. So if you do have a big buy-to-let portfolio, it's kind of like you've got your bond allocation already. But of course, it's illiquid, it's expensive to trade. So it has lots of tax inefficiencies. Buy-to-let isn't a kind of no-brainer, I don't think.
Especially not now.
But if you do have it, and I speak to people who are retired and they've got a pretty good income that comes from buy-to-lets, then they can take more risk with the rest of their portfolio. If it covers their income, then you can buy more equity and maybe leave more for your kids when you pass away.
When with the REIT thing as well, if you're buying a global index fund, you'll have REITs within that anyway, won't you? Because they're listed.
A lot of them have REITs in them. Yeah. So
you're already getting the exposure through the global fund.
You would have some. Yeah. And they trade on an exchange just like stocks. So they're very similar in that sense. Yeah.
So, the takeaway, I want to talk about you in a second because I think you're a bit of an enigma online. So just
Really?
I just don't think we get to see you in Pensioncraft, and you do shine your personality through there. But I think, I want to talk about your story and the jump you made, because I think you did that well before being a finance YouTuber was a thing that people thought you could do. So I want to get into that. But the key takeaway for me from this is that you've worked in this industry in the cult of alpha, where people spend all their time and effort trying to beat the market, and you've come out of that, and now you personally just have a global index fund as your base thing, and that does everything you need it to do, and then everything else is just strapping on complexity and risk, or risk of you making a bad decision, basically, but you do it for a bit of fun. Would you say then that's a good takeaway for someone, that a global index can be just enough?
Yeah, I mean, I speak to some people who do have like these permanent portfolio where they've got gold, they've got bonds, they've got stocks, because they don't like the crashes. But if you're willing to ride out the crashes, I think that would work pretty well, just having global equity.
And by not riding out the crashes, by reducing them, you are reducing your overall return as well, aren't you? Because you're dampening it. By squashing the volatility, you also squash the total return, I would imagine.
Yeah, but not as much as you'd think.
Really?
And that's why it's worth looking at portfolio charts, because one of the portfolios that the guy who creates it has made is called the Golden Butterfly, because it's got 5 allocations. And it looks a little bit like a butterfly when you plot the pie chart, but it does pretty well. And he's got something called an Ulcer index, which is how much things crash and how long they stay crashed. So if it crashes for a long time and it crashes a lot, you get a lot of ulcers. And this is really low on the Ulcer index, because there's always something that doesn't crash in the portfolio. So just play around with it. I'd say, just try these different allocations and see which one suits your goals best. But I speak to people in Australia, for example, and they actually warn that the risk of owning bonds long-term is that they underperform. So that's the risk, underperformance, not having enough risk long-term. So if you don't have enough equity, you will underperform probably, but it's not as clear-cut as you'd think.
No.
That's why the back tests are interesting.
Yeah. But for someone looking to start today, you can grow into this, can't you? You can get your global index, and then over the years play around with a little bit of bonds or set up your other portfolios.
If you're investing for a long period of time, absolutely. If you're 20, that makes absolute sense. But everyone has a different horizon. Yeah. So that's the most important thing when you're determining the allocation. And
if at retirement, say, would there not be an argument to stay 100% equity if we're going to be living till 90?
Weirdly, no. Again, if you do the back test here, if you imagine the amount of money you have over the course of your life, most people start out with very little, and then you kind of build up to a peak, and then you retire, and then you eat what you've built up, and it dies back. So it's kind of like a shark's fin. Yeah. And the point at which you're most sensitive to a crash is when the shark's fin is at its peak. Yeah. So that's why people de-risk just before retirement, maybe 5 years before. Because what you don't want, let's say you're 100% equity, let's say there's a 50% crash just before you retire. Well, you've got to eat, right? Yeah. You can't go to budget and say, I'm sorry, can I just defer this? So you have to eat. So what you do is you de-risk just before, maybe 5 years before. And if you think the crash will last, 5 years at most, until equity recovers, then you set aside 5 years of income and you can live off the low risk stuff, money market funds, cash, those are the lowest risk, maybe slight duration in your portfolio, 7 to 10 year government bonds. And that way, by living off the safe stuff first, you have the best returns.
What's it called when you're kicking your portfolio when it's down? I can't remember the term. Basically,
if you crystallize a loss.
Yeah, if you take them in that initial period, though, it's
called sequencing risk.
Sequencing risk. So it's really damaging.
What's weird is the same crash in year one of retirement has a much bigger impact on how long your money lasts than, say, halfway through or towards the end. So that's why it's sequencing risk.
Yeah. So it's about protecting those first couple of years.
Exactly.
And could you just do that by having cash reserves?
Yeah.
I could have 3 years worth of cash on hand.
Yeah, cash would work.
Because that is de-risking. You have a portion of your portfolio in cash, essentially.
So having cash-like instruments like money market funds or short-term government bonds. Yeah.
Okay, perfect. Well, thank you so much for that. Nice. I'd like to have a brief chat now just about you because I'm fascinated, if that's okay.
Really?
Number one fan. He's got a big poster of you in his room. Honestly, he prays to it every night before bed.
Yeah. So I'm a full-time finance YouTuber. I worked in the finance industry, and I left what was a high-paying job to roll the dice. But you put the feet in the snow first, if that makes sense. So I knew that it was possible because of someone like you. There's you, and then there's probably Meaningful Money that would say we're trailblazers.
I know Pete.
Yeah. Pete Matthews is a great guy. I love him. We speak a lot. Yeah, he's a lovely guy. Why? Why you left the city for, making videos in your spare bedroom?
Well, like I say, I was part of the business university when I was at the bank, and I became a strategist later on, and that was great fun, and I learned a lot. But the most intense, most enjoyable period was when I was teaching finance. So everybody has an exit plan in investment banking. You speak to people in the pub, and they say, "Oh, I'm going to be a carpenter," or "I'm going to be a singer." And they're often really talented people who have these other strings to their bow. And I thought that would be my exit plan. I'd probably go into teaching and creating something like Pensioncraft. I thought it would be more geared towards professional investors. But as it turned out, I think retail investors, the greatest need was there. But I didn't know it was going to work. And for a long time, it didn't work. And, my relationship suffered as a result of that. So it was a very difficult time.
You mean you split up with your partner?
Yeah. So I mean,
because of the channel.
Yeah. I got divorced, and clearly I went from being an absent dad who'd get up before dawn, get back in bed after dark. Sometimes my partner didn't even see me. I went from that to full-time working at home, where it wasn't a proper job, right? I mean, it wasn't seen as a job, and I can see why. I'd have been a pain in the ass to live with, because there was a lot of stress getting the channel working and getting everything off the ground. So there was a long period when I just didn't get many views, and I just didn't think it was going to work. And I thought, well, I'll just give it a bit more time. So it was like anchoring, right? You think, oh, I'll just let it turn around. And it didn't turn around quickly enough for my partner to be kind of happy with sticking with me.
Well, look at you now.
I was about to say, look at me now. Look at me now.
Yeah, but there was no ill will. I think it was just, I understand why she wanted to leave. But yeah, and it was interesting because I had a chat with Pete Matthew early on, and he said, yeah, great idea, but nobody else has managed to make it pay.
How long were you plugging away for?
That was about 2 years of that.
2 years.
Before.
So my second ever video got 400,000 views.
Yeah, well, for me, it took a lot longer.
It
was basically my mum watching the videos initially. So
I think. Did you watch much YouTube prior to it?
Not really.
I did, and I think there's an element of like knowing the platform. So I knew to do like long tail keyword research and to target investing for beginners UK 2020. I was like, that's an underserved keyword. Like I had that strategy. I've seen you started to refine your thumbnails recently.
Yeah, because
really
our video editor has started. He said, "Oh, well, I could do that for you."
Yeah.
So I said,
and they've improved, and they are better. There was a certain like charm of your old ones. Do you know what I mean? Like they're quite.
That's a polite way of putting it.
They were budget.
I mean, we've all been there. Mine aren't perfect. The thumbnails are like this constantly moving science. Yeah. I saw that you've changed that, and I was like, oh, there we go. That's
there's so much doom porn out there. People, if you put the word crash or crisis into the title of a video, everybody clicks on it.
Yeah.
But at a certain point, you've got to stop lying because markets don't crash most of the time, and it stops people doing the right thing. So there's a kind of trade-off there.
Oh, 100%. And, it would be very easy for me to go full on negative all the time. But I actually think you build the audience that you want in a way. Yeah. And, your content will attract people over time. It might not explode. And I think that can give people these false positives. And then before you know it, they're pseudo conspiracy channels where everything is awful. Whereas I've lent into behavioral finance. And no one really does that. And I read the academic papers and I say this. And over time, I've grown an audience that like that kind of content. So I think, it's like the hare and the turtle, isn't it? You might not race out, but you'll build an audience of people who are loyal, who like the content. And, I love your content.
Well, I know when people don't like it.
You mentioned it a couple of times.
It's great. Sometimes, I'm about to make a video, I see you drop, oh, for fuck's sake. He's going to do it better. And I'm just not going to touch that now because people just go, oh, you just copied Ramin. Oh. I remade the life strategy funds on Invest Engine once. And then someone come in and was like, yeah, Ramin did this better.
They're just deflated in his room.
Oh, that's so hard.
Crying himself to sleep.
I gave them I gave them like full on story and narrative, and they just didn't want it.
Oh.
They just wanted you going,
Oh dear. Pointing to graphs, yeah.
yeah.
This graph above my head. Yeah.
No, thank you so much. And thanks for sharing about the breakdown of the relationship. I don't think people realize that YouTube is hard. It takes a lot of effort and time. And within a family setting, everybody almost has to sacrifice for the channel because it's all consuming.
Well, now we've got the community. It's much harder because you have to kind of service the community as well as servicing the channel, producing new content. I mean, one kind of feeds off the other because the channel, the ideas for the videos comes from the community, the questions they ask, which, you just had a question and answer session.
Yeah.
It really inspires you to produce, new content, but also to get into the minds of your listeners. So I think having that rapport is good, but it is a lot of work kind of maintaining a community.
Yeah, well, I say like my boss's public opinion of me, which is like a very different concept for a lot of people. Most people have like one person that they might report to directly, and that'll be the person that keeps them up at night. Yeah. Whereas you feel like responsible to the needs, wants, and almost the financial success of hundreds of people, even though you don't give advice. You feel accountable, don't you, for what you say and what you do. And like you say, you talk about something, people do it. And
you've got to be so careful. Like I made a video about money market funds and the risks, and a lot of people sent an email to me saying, I sold my money market fund. And I thought, no, that's not what I
tell
meant.
you to do that.
I was just talking about the risks.
Yeah.
So I think you've got to be so careful. But then there are certain times when people feed back how much you've changed their life.
Yeah.
And it's just one of those groundbreaking moments in your life, which gives you goosebumps.
If people recognize you in the street?
Yeah. It was so cool because I went out with my partner Laura's grandson and we were going to Pizza Express and somebody recognized me. They came across the street and said,
you're a rock star.
Yeah, so that's right. Especially
so
YouTube,
Yeah.
So that was great.
I bet you're really cool to the kids.
Until I started tutoring him in maths, yeah.
No.
I'm not so cool anymore. We talk about trigonometry now.
Yeah. Well, so obviously we've mentioned what you do, but I just want to mention that you host your own podcast that's excellent.
So it's me and Michael Pugh. He's my podcast co-host. He was a member of our community and now we kind of host it together. And a lot of people are surprised.
You realised he was smarter than you.
We never met it. He is smarter than me. We've never met.
That's why Damien got me here because I'm smarter than him.
Yeah. But that's why this is so different.
I've
never met him and you two work side by side. Very different.
Yeah, that's it. Well,
we're old school friends.
One of the stipulations was I wanted it in person, mainly so I could meet guests like yourself. And I was like,
you were school friends?
Yeah, we went to university together.
We went to uni together.
Cool.
Yeah. So I did my channel alone. That's all just me. And then when Will approached me to do the podcast, they were like, get a yin to your yang or whatever. This is my yang.
We should get a little yin and yang t-shirt. That's cool.
Oh, that is cool.
Thank you so much for your time today.
Thank you. I really enjoyed speaking to you.
It's our pleasure.
Epic.
We're doing the long stare. We always get told to
always want a long stare at the end.
Really?
Because we cut, so it's like hold the stare.
And the first time it was so awkward. I was like, I know him too well to be looking into his eyes like this. This is a bit intense. But now we're just like, If you enjoyed today's episode, you're going to love this one.
And if you want a summary of everything we've discussed, then sign up to our newsletter down below.